Welcome students to another lecture in the series. In the last lecture we finished the different functional budgets. Today we are about to start further few concepts under your budgets and budgetary control. We are about to study fixed and flexible budgets. Based on level of activity or capacity utilization, budgets are classified into two categories, that is fixed budget and flexible budget. Let us see the fixed budget first of all. A fixed budget is the one which is prepared keeping in mind one level of output. It is defined as a budget. Let us see the definition. It is given by CIMA, which is defined to remain unchanged irrespective of the level of activity attained. We are able to see that here is a factor of rigidity, that it is fixed and it cannot change. It remains unchanged irrespective of the level of activity. So if the actual output differs from the budgeted level of output, the variance will arise, but fixed budget is prepared on the assumption that output and sales can be estimated with a fair degree of accuracy. Means whatsoever we have assumed will be true. This means that in those situations where sales and output cannot be accurately estimated, fixed budget does not suit. Where your estimations may prove to be wrong, the fixed budgets may go inappropriate. It may not be suitable to have a fixed budget in that situation. Flexible budget, on the other hand, in contrast to fixed budget, is the one which is designed to change in relation to the level of activity attained. The underlying principle of flexible budget is that a budget is of little use unless cost and revenue are related to the actual volume of production. Flexible budgeting has been developed with the objective of changing the budget figures to correspond with the actual output achieved. So here, budget might be prepared at various levels of activity, means that at 70% capacity, 80% capacity, or 90% capacity, or 100% capacity. So then whatever the level of output actually reached, it can be compared with an appropriate level. Flexible budgets are prepared in those companies where it is extremely difficult to forecast output and sales with accuracy. Okay, so such a situation may arise in certain cases. Let us discuss few where the nature of business is such that the sales are difficult to predict. Means like your demand for luxury goods is quite unpredictable. You'd never know that when the demand would go up. Where sales are affected by weather conditions, like your soft drink industry, woolen garments, where the sales are affected by change in fashion, specifically your ready-made garments, are a very dynamic industry, where company frequently introduces new products, where large part of output is intended for exports. So these are few parts where such situations arise. Use of flexible budgets. The figures that we have in flexible budgets are adaptable to any given set of operating conditions. It is therefore more realistic than a fixed budget, which is true only in one set of operating conditions. Flexible budgets are also useful from control point of view. Actual performance of an executive should be compared with what he should have achieved in actual circumstances and not with what he should have achieved under quite different circumstances. In brief, flexible budgets are more realistic, we can say practical and useful, because rigidity in the fixed budgets, on the other hand, have a limited application because they are not suited um, to each and every situation, and it is sometimes, you can say, suited only for few items like fixed costs. Now, in at this stage, we need to differentiate between fixed and flexible budgets. Let us see the differences. First, fixed budget assumes a static business condition, whereas flexible budget is based on the assumption of changing business conditions, ever changing, which is actually true as per the current business situations. Fixed budget is prepared only for one level of activity, but flexible budgets may be prepared for different capacity levels or for levels of activity. Fixed budget figures are not changed when actual level of activity changes, but on the other hand, we can see flexible budget is something which is adjustable according to the level of activity attained. When actual level of activity differs from budgeted level of activity, then in fixed budgets, meaningful comparison between actual and budget figures is not possible. But in flexible budgets, such comparisons are quite realistic. Under changing business environments, dynamic business environments, fixed budgets are very limited use for control, but flexible budgets are very useful for such cost controls and performance evaluations under the ever changing business environments. Now, let us see how to prepare flexible budgets. To prepare the flexible budgets, it actually necessitates the analysis of all the costs into fixed and variable components. So the two components of the cost, that is fixed and variable, are actually uh, classified here. This analysis, of course, is not peculiar to flexible budgets. It is important in flexible budgeting than fixed budgeting. So this is so because the flexible budgeting varying levels of output are considered, and each class of overhead will be different for each level. So in flexible budgeting, a series of budgets are prepared for every major level of activity. For every major activity, we prepare a different separate budget. So whatever that actual level of output it can achieve, it can be compared with the appropriate budget and can be interpolated between budgets of the activity levels on the either side. So for this can be explained with an example even here. Like budgets can be prepared for different capacity levels. Like for 60% capacity, 60% capacity here refers to that if a machine can produce 10 units, so instead of 10 we are just producing 6 units on that machine. Okay, so it is that 60% 70% capacity. So if the actual level of activity is 85, then the budget allowance is 85% should be computed accordingly. While computing fixed costs at various levels, we should keep in mind that fixed cost in total amount it remains unchanged at various levels of activity. Whatsoever is the production level, the fixed cost remains the same. However, fixed cost per unit decreases when the level of output increases. We know that very well, and vice versa. So fixed cost per unit increases when the level of activity decreases. So regarding the behavior of variable costs, it is very important to note that total variable cost increases in proportion to increase in the level of activity and vice versa. However, variable cost per unit does not change with the level of activity. We know that very well. Just a small concept. Semi-variable costs should be treated separately into fixed and variable component. Fixed component of the semi-variable cost will not change between levels, but variable part of the semi-variable cost will change in the proportion of the level of activity. Let us see this with the help of an example here. We need to draw a flexible budget for overhead expenses on the basis of the data that is given to us with different capacities, 70, 80 and 90% capacity. We need to do that, and we are given with 80% capacity. Variable overheads are given to us: indirect labor, stores including spares. Then we have semi-variable overheads, power, 30% fixed and 70% variable. Repairs and insurance, which has 60% fixed and 40% variable. We have fixed overheads, depreciation, insurance, salaries. Total overheads is also given to us, and estimated direct labor hours are also given to us. Let us see how to draw this. See, the amounts can be easily picked for 80% because it is given to us for 80% capacity, and we will be calculating it for 70% and 90% capacity. So you can see the format here. We have drawn it like this. First of all, we have considered the variable overheads. For 80% capacity, it is 12,000. For 70%, we have calculated with unitary method, and for 90% capacity, also we have calculated it using unitary method. I have shown this on the next slide using working notes. See, you can calculate it like this. Simply, 80, for 80 it is given to us. We can divide it by 80 and multiply it by 70, and we can calculate it for 70 and 90% at various levels. Okay, the way indirect labor cost is calculated, all the others will also be calculated. Like stores including spares, 4,000 is given to us at 80% capacity. We'll divide it by 80 and multiply it by 70 to obtain this amount. Similarly for 90%. Then further for semi-variable overheads, we have got to know that certain percentage is fixed. I'll show you this from the working notes. We know that certain part is fixed, that is 30%. So we have calculated 30% of it and kept as fixed, and variable we have calculated at different capacities. Let us see. We have kept this as fixed, whereas we have kept this 14,000 at 80% capacity and calculated 1790 from it. Same ways for repairs and maintenance, it will be calculated like that. Then we have fixed overheads, depreciation, insurance, salaries, and then total overheads are added up, and estimated direct labor hours are given to us as 1,24,000. We'll calculate this for 70% capacity as well as for 90% capacity, and we'll divide these two amounts and obtain the per hour labor hour cost, direct labor hour rate basically. Then at next level we can have such more examples. This is another question which is given to you here for the purpose of preparing flexible budget. Same ways it will be prepared. Then budget reports. See, establishing budgets in itself is of no use unless there is a continuous flow of budget reports. Means we need to continuously keep a watch on it, compare the actual and the budget figures. So budget reports are prepared at regular intervals, maybe on monthly or weekly basis, showing the reasons for the differences, showing the differences and the reasons also behind them. That why there are differences between actual and budgeted figures. So reports should be prepared in such a way that they establish the responsibility for the variances. Reports should also reveal whether a variance is favorable or unfavorable, and also whether a variance is controllable or uncontrollable. The contents of the budget report differ according to the need of the managerial level, that what information they need. Like I have got an example here. The lower level of management is generally provided with detailed reports of such activities with which the manager is directly concerned. So thus a foreman will be concerned with reports concerning his own section. As the level of management grows higher, the amount of details become less, and although the coverage of the report will be widen up. Essentials of budget report, that what should be there in the budget report. It should be simple and suitable. It should not be complex for the user to understand it. It should be presented promptly. It should have accurate data, but the extreme accuracy should not be at the cost of promptness. The principle of exception should be utilized wherever it is possible for us to do that. The report should contain only essential information according to the needs of the user. Okay, I'll show you the format how to draw the budget reports on the next page. The budget reports may be presented in the form of financial statements, or it can be like this. You can see budget's the name of the budget center for which period it is being drawn. Here we can mention the code number, unique code numbers, items of expenses, the budget, which is as per the budget. We pick these amounts and the actual, and then we see whether the variance is adverse or favorable and the reason for that. So such reports are generated periodically. For this concept, if you have any doubts, if you feel like have to have any queries, you may write to me. Till then, take care.